was a time, like you said, the markets might have been a little bit less efficient. There was less quote unquote hedge funds. And even that whole term hedge fund has become so diluted. I don't think I even know what it really means anymore. But the original concept was to make money in all markets with the potential to be nimble and to be short. But how many managers are really that good on shorts?
Well, shorting is a veil of tears these days. The time was when you shorted 100 shares of stock, and the proceeds, you bought treasury bills that yielded 7, 6, and 9%. So from day one of the transaction, you were making good money. The dividend yield in the shares you sold were nothing like the imagined 7 treasury bill yield. So that was good. And then in days of yore, there was a much less, things were much less correlated. And there were many fewer, if indeed there were any at all, exchange-traded funds. Now, one of the consequences of the proliferation of ETFs is the notion that one ought not to go shopping among individual names, but rather to, quote, gain exposure, close quote, by buying baskets of things, right? So instead of going through stock by stock and looking for the one that answers the various criteria of financial flexibility and growth and good all the things we look for in a thriving business, well, don't do that because you're going to pick the wrong one. And besides, the market is relatively efficient. Rather, gain exposure to the industry group by buying the ETF. Well, what this does is cause the ETF management to buy, or the mutual fund manager to buy pro rata shares of all the companies in the group, good, bad, or indifferent. So when shorts go up as the group, as the concept, gains a following among investors, and the distinctions among and between different securities are rather erased. So it has been a very difficult time for the people who pick stocks for a living and pick bonds for a living.